Okay, folks, so we got the inflation report this morning, and let's just say from the get-go, this is some of the best news that we've seen all year. I want to walk you through the main takeaways of this report and then go over what this means moving forward, as well as, unfortunately, the new sinister demon that is lurking behind the scenes of this report. They say the demon that you know is better than the demon that you don't know, so I want to help you guys get acquainted. And then I'm going to walk you through Blackrock's new warning and explain where and when they see the biggest opportunity and what they see coming in 2023. I will put all the timestamps down below. And today's video is brought to you by Moomoo and the up to 20 free stocks that you can get by opening an account with our link down below. Excellent trading platform and broker, and while inflation may be slowing down a bit, well, the number of free stocks they're giving to new users isn't. Make sure to grab them while you can. I think you're going to like the platform a lot though, so don't just join for the free stocks. I think you're going to like the whole thing. Okay, so in totality, today's report was the smallest 12-month increase since the period ending December 2021. In terms of expectations heading into it, nowcasts, we're expecting month-over-month CPI to come in at 0.47 and core to come in at 0.51. In terms of broader market expectations for Wall Street on overall CPI, all item CPI, the expectation was about 0.3. But instead, inflation was a lot cooler than both of those estimates, and we ended up getting 0.1 on overall CPI. I did not think that the day would come where I would be alive and I could say that we have some good news on inflation, but here we are. And then for core, we got 0.2, which rose by the smallest amount since 2021, and this brings the year-over-year inflation rate down to 7.1% on all items and 6% on core. Obviously, both still horrible year-over-year, but it's all relative. This is relatively good news compared to everything else that we have this year. To better visualize this, look at the overall trend on the core CPI. Whether you're looking at the 3-month change trend or the 1-month, it's clearly trending in the right direction, at least for the time being. And it's the most convincing trend that we've seen in this cycle. And I can't emphasize convincing enough. We know how markets look at this trend. They look at this trend and they say it has to continue, when in reality, it could go right back up next month if some different pricing pressures reverse. But right now, you're seeing a convincing downtrend, one that we haven't seen before. And you may not have caught this, folks, but if you check the Fed futures for tomorrow's Fed meeting and the rate hike decision, they are about the same, factoring in a majority chance of a 50 basis point hike. But for the February meeting, and this is where it gets interesting, the chance of a 50 basis point hike actually went down, and the chance of a 25 basis point hike went up, which means what? Well, it means that markets are affirming the belief that the Fed is going to be able to start slowing the pace of rate hikes. Markets now are solidifying the trajectory of a 50 basis point hike tomorrow and a 25 basis point hike in the February meeting, which creates this dynamic where funds that were expecting higher rate hikes and a higher terminal rate, well, they can go in and buy, and they have a new risk managed position. You go over to the Treasury yields, also took a dive, expecting the Fed to slow pace. But going back to the report, this is the most convincing report we've seen that shows some evidence that prices are not just moderating, but they are also actually falling. Medical care service prices dipped into the negative for the second consecutive month. Transportation services finally dipped into the negative. Used cars and trucks had their biggest drop yet. Commodity, less food and energy, biggest drop yet. Utilities, negative. Electricity, negative. Overall energy services, negative. Energy commodities overall, negative. Gasoline, negative. The vast majority of major line items on this chart were either negative or were cooling down the pace of increase from the previous month. One worrisome line item that I will highlight, though, is shelter. Still very aggressive in terms of an uptrend, down from a 0.8% increase, but still increasing at a rate of 0.6, which really isn't that much better. And considering that this is a huge budget line item for consumers, obviously this is a disaster. I mean, housing is like 30% of people's income, sometimes more. So the fact that this is still staying high and accelerating to the upside is not something that you want to see. However, at the same time, of course, housing is a lot slower to adjust than everything else, and once you're locked into a lease, oftentimes it's hard for the landlord to raise rent on you, at least for the first year or every year consecutive that you have a contract with them, unless you're on month to month, which a lot of people are after that first year ends. But overall, it takes some time for those prices to adjust. So net and in effect, the takeaway is yes, we're getting some disinflation. Now, what you do have to keep in mind, though, is the market sentiment heading into this. Markets were already busy crafting a new narrative, and the inflation print today just added more evidence that they may be right. You go over to this chart from Bloomberg, bond markets were already in the process of doing something that they rarely do, expecting substantial disinflation in a very short amount of time. In black, you have the 1-year break-even spread to the CPI, which signifies how much markets think the CPI is going to change over the next year, and in red, you have the 12-month change in CPI that we've already seen. If you take this at face value, markets are now expecting price gains to slow by more than 5 percentage points in the next 12 months. That's a very, very fast pace of disinflationary pressures. Today's report puts us on track to meet that goal, but there's a new issue behind the scenes here. A lot of people have this magical fairy tale idea that you can get substantial price drops without having any sort of substantial pain. But according to Bloomberg, the 5 percentage point drop is a pace seen in only 3 instances in the past 6 decades. And each of these occasions happened during or just after a recession. Which means what? Well, it means that the pace that bond markets are expecting inflationary pressures to drop at indicate that the expectation isn't for a soft landing at all, but rather for a crash landing that forces prices down in a similar fashion to what we saw during the Great Financial Crisis, where 1-year break-evens also predated the actual 12-month CPI change pretty accurately. If inflation is expected to be crushed this quickly and history is any indication, that means there has to be a massive recession in the next 12 months. If you have collapsing pricing pressures, that means that you have to have collapsing demand. If you have collapsing demand, what does that mean? Well, you have collapsing businesses. The idea of a soft landing and rapidly collapsing demand don't really go together. It's kind of like Taco Bell and a healthy stomach. Those don't go together either. And in both situations, you're in for a shite storm. To understand this, I want to go over to what Blackrock is saying in their recent report. Blackrock says to throw out your old investment playbook because we're headed for a new regime of greater macro and market volatility. Charlie, really? Greater macro and market volatility? My rear end cheeks still hurt from getting spanked in 2022. They start, the great moderation, the 4-decade period of largely stable activity and inflation is behind us. The new regime of greater macro and market volatility is playing out. A recession is foretold. Central banks are on the course to over-tighten policy as they seek to tame inflation. So 3 things here. Number 1, they are saying that we are leaving a period of 4-decade overall consistent stable growth and in control inflation, which by the way, the inflation of the last 4 decades was only under control because they changed the way that the CPI was calculated. And then the second thing they're saying is that we are heading into a new regime where macro and market volatility is going to be at a scale that we haven't seen in the last 40 years. That's going to be the new norm. And number 3, the third takeaway from this is that in order to get inflation tamed, central banks will have to over-tighten policy and punish economies as much as they see fit. And this is going to be on a rolling scale because inflation is going to be entrenched in our economy at a much higher rate than 2% for the upcoming decades, according to Blackrock and their analysis here. Moving on, we expect to turn more positive on risk assets at some point in 2023, but we are not there yet. And when we get there, we don't see the sustained bull markets of the past. That's why a new investment playbook is needed. So they are projecting that we get a rotation back into risk on assets at some point in 2023, which is because they believe there's going to be another huge sell-off priced in before that point. But they also believe that the new bull market isn't going to be like the bull markets of the past. It's going to be a lot more disorderly and a lot less consistent, as Blackrock believes the Fed will have to go back and forth on savior missions to fight inflation. You'll get periods where inflation seems to have let up and then boom, you're back in spiraling inflation, so on and so forth. Now, reasons for this new environment or regime as they call it, well, they cite ongoing production constraints, aging populations, record debt levels, geopolitical tensions, and green energy policies. They think these things together are just a few of the factors that are going to keep inflation problematically high for years down the road. And thus they're saying here very boldly, whatever investment strategy was used successfully in the last 40 years, well, that's not going to work in the next 40 years. And it's their view that taming inflation would take a deep, deep recession. If you pull up their chart, in orange you have the GDP, and in green you have where the GDP should be at if we want a non-inflationary GDP level. And Blackrock is saying, hey, our GDP needs to fall significantly if we want to close the gap between demand and supply in 2023. If the Fed is serious about bringing inflation down to 2%, they need to put ice across the economy and destroy these GDP numbers first. They need to cool things down to the point where we're barely moving. You get numbers like this and a lot of people are going to lose their jobs. A lot of people aren't going to have any money to spend on anything. A lot of people's quality of life are going to be downgraded substantially. But this is what Blackrock is saying is going to be necessary to be forced upon the population in order to get inflation to 2%. Although at the same time, you have a lot of analysts that are saying, no, actually, you can have your cake and eat it too. You can get away with all the money printing. You can get away with all of these sloppy policies policy making of the last several decades. And BlackRock is saying, no, we're sorry, but actually you have to have some pain to get rid of this inflation. You can't just get out of it without any pain. Historic inflation is only cured by historic pain. But BlackRock also seems to be suggesting that the Fed isn't going to be able to do what it takes. They're not going to be willing to do what it takes. Instead of fighting inflation and getting it down to 2%, they're going to quit far, far above that 2% target rate, which is going to prolong the inflation battle for many, many, many years to come, which is the whole thesis that BlackRock is operating at when it comes down to this new regime prediction. Signs of a slowdown are emerging, but as the damage becomes real, we believe they'll stop their hikes even though inflation won't be on track to get all the way down to 2%. So BlackRock here is saying that the Fed won't achieve its 2% goal because it won't be willing to destroy the economy nearly enough. Charlie, is BlackRock full of idiots? Don't they see inflation is already down several months in a row? Don't they see that that guarantees that inflation must go straight down to 2%? Well, according to them, they call that simply wishful thinking. This is a chart that shows just how wishful analysts' inflation predictions have been since mid-2021. Each of them expects inflation to plummet in the periods in the future, but each time it went up afterwards, rendering them wrong very, very quickly. Some of them really wrong. And so BlackRock is saying, hey, are we going to fall for the analyst prediction that inflation is going down again this time? Now, again, I'm just reading you BlackRock's take on this. In my view, a lot of commodity prices are going down. A lot of trends seem to be pretty aggressively down. But if you look at this on a broader picture, are they going to go down to 2%? How fast is that going to be? Could they not just motivate back up to the upside 3, 4, 5 months from now, and all of a sudden there's a new cycle where the Fed has a problem? I think without a massive recession restricting demand and restricting the circulation of that capital, well, I think it's highly likely that you just get another inflationary spiral sometime down the road once inflation starts heating up again, once spending inevitably comes back if you don't get a recession. And I think that's what BlackRock's arguing here. Hey, you're either going to get a massive recession or you're going to get a mini recession, a mini cool down that then just leads to the Fed having to continuously go and fight back and forth with inflation for years and years and years. So what is BlackRock's playbook then? Well, right now they are positioning risk off and are of the viewpoint that damage has not yet been priced in. They are underweighting equities and long-term bonds and overweighting credit. But once we head into a risk-on period, which they believe will happen sometime in the back half of 2023, they are going to start overweighting equities again, and they're going to start really overweighting them if you get sufficient damage priced in ahead of time. Now, it seems like they're playing a little bit of a Fed pivot here, thinking, okay, once the Fed pivots, all of a sudden you get that massive, massive rally, and you go, and before the Fed has to go in reverse course again and start trying to crank down on the next wave of inflation, they sell out, and they take their profits. They also seem to think that the beginning of 2023 is going to play out in their favor quite a lot. They expect the central bank to stop hiking and activity to stabilize after a dump, but first they expect an earnings shock because earnings expectations, according to them, don't yet price in even a mild recession. And this is pretty well known. If you look at official analyst price targets, very, very few of them are even mentioning the idea of a mild recession, which BlackRock is saying, well, that sets you up for a systematic problem, because if you're too optimistic and all of a sudden you get numbers that are missing all of these cheery estimates, well, all of a sudden, boop, 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 boop. Anyways, tying this back to the inflation news, if inflation really is down, that's a big win. But that's just a win for now. It is my view that if you want to see inflation go down to the Fed's target rate at 2% anytime soon, you're going to need a massive recession for that to happen. So buckle up, folks. We've got a lot of volatility coming in 2023 and beyond. Anyways, that caps off today's video. Let us know your thoughts down below. Make sure to hit that ravishing like button and subscribe, and we will see you in the next video.